Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 117, recorded here on May 26, 2024. This podcast is for entertainment only and is not investing advice, so please do your own homework. All right, so we've got the market update outlook and the top Bitcoin news this week. Lots of stuff to talk about this week, so let's jump right in. The S&P 500 index on Friday just about eked out a 5-week win streak, its longest such run since early February. However, since closing at a record level on Tuesday, Wall Street's benchmark gauge has stalled and its weekly advance has been capped by a growing sense of uncertainty among market participants over expected interest rate cuts by the Federal Reserve. The latest Fed minutes, coupled with cautious commentary from Fed speakers and unfavorable economic data, dented sentiment. On the other hand, the tech-heavy Nasdaq Composite got a shot in the arm on the back of a massive surge in shares of Nvidia following yet another blowout quarterly report from the chip giant. The S&P 500 added 0.03% for the week, while the Nasdaq climbed 1.4%. Conversely, the blue chip Dow fell 2.3%. Looking ahead, investors will be paying close attention to Friday's personal income and outlays data. That report will contain a reading on the Federal Reserve's favored inflation gauge, the Core Personal Consumption Expenditures Price Index. With interest rate cut uncertainties stalling Wall Street's rally this past week, the core PCE deflator has the potential to move markets. There will also be readings on inflation from European countries and Japan. The first quarter earnings season is largely winded down, but there will still be a few major names reporting this week. Chief among them will be discount retailer Costco, which last closed at a record high, and Dow 30 component Salesforce. The cryptocurrency world will grab some of the spotlight when the high-profile CoinDesk Consensus event will get underway on Wednesday. The mega crypto event will include participation from independent presidential candidate Robert F. Kennedy Jr. and ARK Invest's Cathie Wood. Okay, getting into the top Bitcoin news for the week, we'll start. This is from Bitcoin.com. This was posted today, and this is the week in review. Haven't done one of these in a while. So first up, the U.S. Securities and Exchange Commission has approved pivotal 19B4 filings for spot Ether ETFs, marking a major regulatory milestone for the cryptocurrency sector. This approval indicates a newfound willingness to engage with other ETF issuers. And of course, we don't like ETFs even for Bitcoin. And we certainly don't like Ethereum because there is no cap. But the sentiment is changing, and we'll hear more about that as we get a little further into this episode, which, of course, benefits Bitcoin indirectly. Economist Jim Rickards forecasts that gold prices could surpass $27,000, emphasizing that this projection is not made for attention or shock value. It's the result of rigorous analysis, he clarified. This represents a significant increase from his previous estimate of $15,000 by 2026. Boy, if gold goes that high, I can only imagine what Bitcoin would be worth. Based on the latest data, a well-known Genesis address owned by Satoshi Nakamoto now holds over 100 Bitcoin after someone inadvertently sent 0.10754671 Bitcoin valued at $7,211 to the wallet. The current value of the wallet, which has never been spent, is estimated at $6.75 million. Thanks for the donation. This week, the crypto community has been buzzing about a new token called Notcoin. Okay, I'm not going to read this. Sorry. Who cares? In May 2022, Nigeria's Securities and Exchange Commission introduced a robust regulatory framework for virtual asset service providers, including digital asset exchanges. The framework required compliance with various laws and regulations to foster market integrity, safeguard investors, and deter financial crimes. Boy, they can't make up their mind over there. Are they in? Are they out? Who knows? Big country though, a lot of crypto users in Nigeria. So I'll have to continue to watch that one. Next up from Bitcoin.com, this was also updated today. Donald Trump pledges to stop Biden's anti-crypto agenda, protect Bitcoin, and free Ross Ulbricht. So it's election season, and the politicians are out and about, and crypto seems to be now taking their attention, which isn't a bad thing, I don't think. Of course, you can't trust them, and I mean, they'll make promises and then they won't keep them. But it's an interesting twist in this election cycle, no doubt. Former U.S. President and presidential candidate Donald Trump addressed the Libertarian National Convention in Washington, D.C. on Saturday, although I heard he got booed a lot too. It's kind of funny. Anyway, he covered many topics, emphasizing the importance of Libertarian-Republican collaboration for electoral success. On the subject of cryptocurrency, Trump said, I will also stop Joe Biden's crusade to crush crypto. We're going to stop it. I will ensure that the future of crypto and the future of Bitcoin will be made in the USA, not driven overseas. I will support the right to self-custody, he added. To the nation's 50 million crypto holders, I say this. With your vote, I will keep Elizabeth Warren and her goons away from your Bitcoin, and I will never allow the creation of a central bank digital currency. Trump also stated, if you vote for me on day one, I will commute the sentence of Ross Ulbricht to a sentence of time served. He's already served 11 years. We're going to get him home. I am proud that I have put forward a detailed plan to smash the censorship and industrial complex and restore free speech. Trump continued, on day one, I will sign an executive order banning federal agencies from colluding to censor the lawful speech of American citizens. We will remove the rogue bureaucrats who conspire to take away your First Amendment freedoms. We will do that quickly. I will once again slash a record number of liberty-destroying regulations. I will stop Joe Biden's plan for the largest tax increase in the history of our country. Following his speech at the Libertarian National Convention, Trump posted on his social media platform, Truth Social, I am very positive and open-minded to cryptocurrency companies and all things related to this new and burgeoning industry. He stressed that the U.S. must be the leader in the field, emphasizing there is no second place. He also slammed Joe Biden, calling him the worst president in the history of our country, noting that he wants it to die a slow and painful death. Trump concluded, that will never happen with me. Trump has significantly shifted his stance on cryptocurrencies since his 2019 Twitter, now X post, where he described, I'm not a fan of Bitcoin and other cryptocurrencies, which are not money, and whose value is highly volatile and based on thin air. Since leaving office, Trump has launched 3 non-fungible token collections. The former U.S. president is now the first major party nominee to accept campaign donations in cryptocurrency. Chris Giancarlo, former chairman of the Commodity Futures Trading Commission, views Trump as the first crypto president due to the approval of Bitcoin futures exchange traded funds during his administration. Recently, Trump criticized Joe Biden's understanding of crypto, urging supporters of cryptocurrency to vote for him. In March, the 45th U.S. president referred to Bitcoin as an additional form of currency, and in February, he acknowledged its growing popularity, stating that Bitcoin has taken on a life of its own, and he can live with it. So again, politicians like to say lots of things during election season. Certainly not going to get too excited about this, but it is quite fascinating to see the narrative change. You know, it's a much more positive narrative now towards Bitcoin, which can't complain too much about. More good news this week. This article is from bitcoinnews.com. This was posted on May 18th. Congress overturns SAB 121 ruling. We are so back. In a showdown in Washington, the U.S. Congress has taken steps to challenge the Securities and Exchange Commission over a controversial policy related to digital assets. The issue centers on the SEC's Staff Accounting Bulletin 121, which has sparked fierce debate among lawmakers, the Bitcoin community, and banking executives. SAB 121, introduced in 2022, requires banks and other publicly traded companies to account for customers' digital assets on their balance sheets and maintain capital against them. This rule aims to enhance transparency and protect investors by highlighting the obligations and risks associated with safeguarding these assets. However, critics argue that the policy complicates financial reporting, increases operational burdens, and stifles innovation in the burgeoning digital asset sector. On May 16th, both the House of Representatives and the Senate voted to overturn SAB 121. The House passed HJ Resolution 109, introduced by Representatives Mike Flood and Wiley Nickel, while the Senate companion measure was introduced by Senator Cynthia Lummis. The Senate vote was 60 to 38 in favor of the resolution, with a notable bipartisan effort seeing a dozen Democrats join the majority of Republicans in opposition to the SEC's rule. Senator Lummis described SAB 121 as a disaster and criticized its lack of consumer protection. She stated, "This is a win for financial innovation and a clear rebuke of the way the Biden administration and Chair Gary Gensler have treated crypto assets, and marks the first time both chambers of Congress have passed standalone crypto legislation." She also celebrated the win with a laser eyes post on social media platform X captioned, "We are so back." Interestingly enough, the letter B in back is the Bitcoin's logo. Senator Lummis emphasized that President Biden should pay attention to the bipartisan backing the Congressional Review Act garnered in both the House and Senate, urging him to sign it into law. The Blockchain Association advocacy group expressed surprise by the 60 yeas votes, which demonstrated significant disapproval of the rule from both chambers of Congress. Despite the strong congressional support for overturning SAB 121, the resolution now faces a significant hurdle: President Joe Biden's veto threat. Representative Mike Flood echoed these sentiments, praising the bipartisan support and urging President Biden to reconsider his veto threat. The White House had expressed concerns that repealing the rule could undermine investor protection and financial stability. A statement from the White House administration highlighted the potential risks, stating, "SAB 121 was issued in response to demonstrated technological, legal, and regulatory risks that have caused substantial losses to consumers." The administration emphasized that restricting the SEC's capacity to regulate digital assets effectively could lead to significant financial instability and uncertainty in the market. Nevertheless, the SEC's rule has drawn sharp criticism, not only from lawmakers, but also from key figures in the Bitcoin industry. Congressman Wiley Nickel has been vocal in his opposition, arguing that SAB 121 amounts to a prohibitively expensive regulatory burden and forces U.S. consumers to rely on riskier offshore custody solutions. He warned that SEC's approach to digital assets is misguided and criticized the enforcement of the rule as a breach of the traditional rulemaking process. Congressman Nickel added, "The SEC's open hostility toward the digital assets industry isn't serving President Biden's best interests. The SEC is turning cryptocurrency regulation into a political football and forcing President Biden to choose sides." Austin Campbell, founder of Zero Knowledge Consulting, described SAB 121 as insanity, suggesting that it could have contributed to the collapse of FTX by preventing regulated custodians from serving customers and exchanges. He emphasized the need for a more balanced regulatory framework that doesn't lock major financial institutions out of the growing demand for Bitcoin services. U.S. House Majority Whip Tom Emmer also emphasized that President Joe Biden faces strong scrutiny over whether he'll approve or reject the CRA before the elections. Rob Nichols, president and CEO of the American Bankers Association, praised congressional leaders, particularly Senator Lummis and Representatives Nickel and Flood, for their leadership in guiding the CRA resolution of disapproval for the SEC's SAB 121 through both chambers. The American Bankers Association. I wonder why. He emphasized the bipartisan nature of the votes, portraying them as a rebuke of the SEC's decision to alter accounting treatment for custodied assets, which could jeopardize banks' ability to offer secure digital asset services to consumers. Aha! Money! The banks are missing out. Coinbase is getting all the business. Nichols stressed the importance of bank custodianship for digital assets, warning that without it, consumers would be left with poorly regulated options for safeguarding their assets. He urged President Biden to promptly sign the resolution into law to protect American consumers. The debate over SAB 121 comes at a time when countries around the world are grappling with how to regulate the rapidly evolving Bitcoin market. In India, regulators are proposing a multi-regulator oversight framework for digital assets trading, while Switzerland plans to implement the crypto asset reporting framework to enhance tax transparency. In the US, the outcome of the SAB 121 controversy could have significant implications for future Bitcoin legislation. Representative Mike Flood has suggested that this resolution could pave the way for the Financial Innovation and Technology for the 21st Century Act, which aims to define the regulatory roles of the SEC and the Commodities Future Trading Commission concerning digital assets. So this one will probably get through, I think. I mean, it's got bipartisan support in the Congress. The president's threatened to veto, but it's election year. He wants to get reelected. He might want to just go ahead and sign that. And of course, the banks all want it because they want to make money. And, one might argue, again, I'm not a fan of ETFs, as you probably know by now. But it's certainly, if you're going to hold your Bitcoin in an ETF, it's probably better to have a bunch of banks, custodying the assets rather than having it all with Coinbase, which is, I think, pretty much everybody's with Coinbase. I think a couple of the ETF issuers have their own custody arrangements, or they're using someone other than Coinbase, but doesn't really solve the problem, but of centralization, but it certainly creates a little bit less risk. And if Coinbase, for whatever reason, gets rugged, that would be kind of a problem. Next up is an opinion piece from CoinDesk. This was posted on May 23rd, and this is in response to the FIT21 bill that I think the House approved it. The Senate still has to come up with their version. But anyway, this one is entitled, "Is the House's FIT21 bill really the legislation that crypto needs?" The House voted 279 to 136 on Wednesday to pass the much heralded Financial Innovation and Technology for the 21st Century Act, FIT21, which has been cast as a major win for the industry, considering this is the furthest any crypto-focused legislation has made it thus far in the U.S. The bill, which saw support from the vast majority of Republicans as well as 71 Democrats, will now head to the Senate, though likely not this year. If passed, the bill would set up a regulatory framework for digital assets, helping to define when a certain token is a security or a commodity. While the bill is largely thought to increase the Commodity Futures Trading Commission's oversight of crypto, the Securities and Exchange Commission would likely continue to play a significant role in regulating the industry. While many have said the bill is something of a turning point for crypto in the US, not everyone thinks it will pan out as expected. It does not even shift agencies. SEC would still have huge power. It provides for a dual regulatory regime split between SEC and CFTC. It does this by giving the CFTC authority it never had, regulatory authority over a spot commodities market. Crypto legal expert Gabriel Shapiro said on X, "Man, we have been psyoped so bad on this FIT21 thing. There has never been never before been a spot commodities market that is regulated. We are just handing this authority over wholesale to the CFTC and hoping they are not insane fascists like Gary, but he used to be head of CFTC, LOL, he added. In other words, the bill is essentially a way for the government to sanction activities that the industry has already been doing without permission and potentially sets up an agency to interfere with what are supposedly free and open markets. It was a point echoed by Stephen Palley, another leading legal voice in crypto, who said he does not like it at all. It needlessly creates more jurisdiction for CFTC over spot and a walled garden for incumbents, among other things. But you dipshits kept asking for new laws, Pally, a partner at Brown Rudnick, added. Somewhat ironically, Shapiro and Pally's criticisms seem to line up with Maxine Waters and the ranking Democrat on the House Financial Services Committee, who said it was one of the worst bills she's ever seen. In addition to potentially stretching the resources of the CFTC, which only has around 700 employees compared to the SEC's 4,500. Wow. It may also undermine other legislative efforts like the stablecoin bill Waters worked on alongside House Financial Services Chair Patrick McHenry. Let me let you in on a secret that the big crypto doesn't want you to know even under this bill, Waters said. The CFTC does not get enough authority to regulate crypto in this bill. Likewise, SEC Chair Gary Gensler has said the effort would create more confusion and regulatory gaps than it closes. Gensler has said for years that the law is clear and that there should not be a bespoke rules for crypto. Regardless, many in the crypto industry have seen the bipartisan vote as a symbolic vote for crypto itself, perhaps a harbinger of a better future. The move comes just days after the House and Senate voted to repeal a controversial SEC accounting rule, which itself was seen as a sign that sanity will ultimately prevail. If there is a silver lining, many experts think FIT21 is likely to die on the vine. T.D. Cowen, for instance, said a few weeks ago the bill stood no chance of becoming law in this Congress, so maybe this is one psyop worth celebrating. And one thing I did read, which is kind of interesting, is just sort of how they came up with, the definitions of what's a security versus a commodity. And they're somewhat random and arbitrary and basically would kind of sweep everything into the commodity bucket, you would think, based on how it was written, everything that's existing that's out there today. There is a little issue with staking that kind of puts it more in the security bucket. And so then you have Ethereum, which is, which is it? And who gets to regulate that? Does the SEC regulate the staking and the CFTC regulates the spot market for ETF? For ETFs or for Ethereum? I don't know. So doesn't sound like much is going to happen with this year, but everybody is celebrating it and some people are trolling it. And I guess time will tell whether or not this actually gets passed into law, but it's true. It won't be this Congress. It'll be the next one that if they take it up. Next up is also, I guess, good news. This is from Bitcoin.com. U.S. House passes Central Bank Digital Currency Anti-Surveillance State Act. Following the passage of the landmark crypto bill, the Financial Innovation and Technology for the 21st Century Act, the U.S. House of Representatives passed the CBDC Anti-Surveillance Act on Thursday. Well, everybody's just busy. I guess they want to get reelected. Majority Whip Tom Emmer wrote on social media platform X, the House of Representatives just passed our CBDC Anti-Surveillance State Act. For more than 2 years, we've worked to educate, grow support, and pass this important legislation, which prevents unelected bureaucrats from issuing a financial surveillance tool to fundamentally undermine our American values. The congressman added, my legislation ensures that the United States digital currency policy remains in the hands of the American people, so that any development of digital money reflects our values of privacy, individual sovereignty, and free market competitiveness. This is what the future global digital economy needs. We are proud to have led this effort and thank my colleagues for their support, he further opined. Representative Emmer explained on the House floor before the vote, this bill is simple. It halts the efforts of this administrative state under President Biden from issuing a financial surveillance tool that, if not done correctly, will fundamentally alter the lives of every American. The congressman stressed whatever is ultimately developed must emulate the core tenets of cash. Simply put, any digital currency issued by the government, again, must be open, permissionless, and private. He emphasized it cannot be used in the way the Chinese have deployed their digital yuan to build social credit scores on their citizens based on their purchases and their behavior. These types of tools cannot exist in a free society like ours, and we should only accept a digital currency that's consistent with our values. Emmer noted this bill was the first anti-central bank digital currency legislative effort introduced in the United States. And while we applaud them for this effort, and this certainly seems like a step forward for freedom and liberty, there's plenty of other ways for the government to surveil us, and plenty of other legislation that's been passed, and even recently, that increases that. So, yeah, good. Hats off. Next up is from Cointelegraph. This was posted on May 24th. Marathon Digital enters renewable energy partnership with Kenyan government. Bitcoin mining giant Marathon Digital recently announced a new partnership with Kenya's Ministry of Energy and Petroleum to develop the country's already thriving renewable energy sector. The partnership will focus on exchanging technical knowledge and research, policy ideas, investment strategies, and the development of critical energy infrastructure. In the wake of the newly inked collaboration, Marathon Digital CEO Fred Thiel noted the advantages of fostering such a relationship with Kenya's Ministry of Energy and Petroleum. This agreement with the Ministry of Energy and Petroleum is a pivotal moment for our business, as it provides us with a clear framework to pursue opportunities across the Republic of Kenya. It demonstrates the innovative approach that Kenya is taking to optimize their energy usage and to enhance their technological infrastructure. According to the International Trade Administration, more than 80% of Kenya's electricity is generated through renewable energy sources. Kenya's renewable energy sector uses a mixture of wind, solar, hydroelectric power, and geothermal energy to provide power to the grid, with geothermal energy contributing the largest amount of power to the country's electrical infrastructure. The ITA also noted that Kenya is one of the world's lowest cost geothermal energy producers and a prime candidate for solar energy generation due to the ample amounts of sunlight the African country receives every year. MOEP's partnership with Marathon Digital marks a surprising shift for Kenya's government, which has been exploring avenues to regulate digital assets, yet has been somewhat cautious, if not outright hostile, towards the adoption of novel blockchain and cryptocurrency projects. After a series of recommendations from government agencies and officials, the government of Kenya banned WorldCoin from operating in the country for 1 year in September 2023. Well, that wasn't a bad idea. The government cited privacy concerns, a lack of transparency, and security issues with WorldCoin's collection of biometric data as the primary drivers behind the ban. WorldCoin may be able to resume operations in Kenya after the 1 year ban has been lifted, but it must reapply and gain regulatory approval from Kenya's Capital Markets Authority before offering its services in the country again. And yeah, that, scan your retina, get a few shit coins. No, not good. Additionally, the project must complete a data protection and impact assessment, state-administered data security workshop before restarting its operations in Kenya. Well, again, I applaud them for banning WorldCoin. Hopefully they'll embrace Bitcoin and Bitcoin mining. Seems like a smart move. It's worked out pretty good for El Salvador. Okay, next up is from Bitcoin.com news. This was posted on May 26th, today. Bitcoin white paper returns to Bitcoin.org following Wright's defeat. In a significant development for the Bitcoin community, the Bitcoin white paper has been reinstated on the Bitcoin.org website. This move follows a series of intense legal battles involving Craig Wright, who has long claimed to be Satoshi Nakamoto, the pseudonymous creator of Bitcoin. Despite his efforts, Wright faced a severe setback in a London court, leading to the restoration of the white paper on the site. The trouble began in 2021 when Craig Wright successfully sued the anonymous group known as Cobra, which operates Bitcoin.org, for copyright infringement. Wright claimed that he authored the Bitcoin white paper and therefore held the copyright. The court sided with Wright by default when Cobra chose not to defend itself, likely to maintain its anonymity. As a result, Bitcoin.org was ordered to remove the white paper, and Cobra was required to pay £35,000, approximately $40,100 in legal fees. Due to the legal constraints imposed by the court's decision, Bitcoin.org had to restrict access to the white paper for users in the UK. Instead of the document, UK visitors saw a quote from Satoshi Nakamoto: "It takes advantage of the nature of information being easy to spread but hard to stifle." This restriction was a direct consequence of Wright's legal victory, which at the time seemed to bolster his claims of being Nakamoto. In 2023, Wright escalated his efforts by suing 13 Bitcoin Core developers and several prominent companies, including Blockstream, Coinbase, and Block. He alleged copyright violations concerning the Bitcoin white paper, its file format, and database rights to the Bitcoin blockchain. This series of lawsuits aimed to assert his ownership over Bitcoin's core intellectual property. Soon after, an alliance called the Bitcoin Legal Defense Fund was formed, aiming to protect Bitcoin developers from such lawsuits, highlighting the detrimental impact of Wright's legal actions. They noted that these lawsuits deterred development due to the significant time, stress, financial burden, and legal risks involved. The community viewed Wright's claims as baseless and part of a broader pattern of abusive litigation. The Crypto Open Patent Alliance, or COPA, a coalition of leading companies, brought a case against Wright, accusing him of fabricating evidence to support his claims. COPA alleged that Wright engaged in an elaborate scheme of forgery and deception. In March 2024, a UK High Court delivered a detailed ruling against Wright. The case's judge remarked that Wright had lied extensively, engaged in technobabble, and was not nearly as clever as he thinks he is. This ruling decisively undermined Wright's claims and invalidated his copyright victory. Following this verdict, the Bitcoin white paper was reinstated on Bitcoin.org. Hennedy Stepanov, the site's maintainer, announced the return by sharing a link to the PDF on Platform X. This marked a significant victory for the Bitcoin community, which has long resisted Wright's attempts to claim ownership over the white paper. The Bitcoin community and various governments rallied to support the dissemination of the Bitcoin white paper. In an act of defiance against Wright's threats to sue anyone hosting the document, numerous publishers and entities shared the white paper on their platforms. Notably, the digital assets arm of Jack Dorsey's Square, as well as the governments of the United States, Estonia, and Colombia, hosted the document. One dedicated anonymous user compiled a list of over 100 websites hosting the white paper, describing it as a way of fighting back against Wright's nonsense. This widespread support underscored the community's commitment to preserving and sharing Bitcoin's foundational document. It's worth mentioning that the court also decided to freeze Wright's assets valued at £6.7 million, or $8.4 million, aiming to prevent him from evading court costs. This ruling, coupled with the detailed judgment discrediting Wright, reinforced the open source status of the Bitcoin white paper. The Bitcoin white paper is now under an MIT open source license, allowing anyone to reuse and modify the code for any purpose. This ensures that the document remains freely accessible and integral to the continued development and innovation within the Bitcoin space. So, bye-bye, Craig. Next up from Crypto Potato, this was posted on May 25th. Spot Bitcoin ETF inflows equal March record as Bitcoin price heads for 69,000. Spot Bitcoin ETFs had some hard times at the end of April, and especially on May 1st, but the trend has changed now with 10 consecutive days of positive flows. This comes as Bitcoin's price went on a roller coaster, propelled by the news surrounding the Ethereum ETFs, but the asset now heads towards 69,000. The cryptocurrency industry saw a massive milestone in January when the U.S. Securities and Exchange Commission finally greenlighted nearly a dozen spot Bitcoin ETFs after a decade of rejecting or delaying every application. The effects were immediate as these products started attracting billions of dollars in the first few months. Then came April, though, when the trend changed and there were numerous days in the red. May 1st was the most painful in terms of outflows, as the total amount withdrawn on that date was north of $560 million. The tides turned once again in the following weeks, especially after the favorable data from the US CPI numbers for April. In fact, May 10th was the last date when the largest ETFs saw negative numbers. The financial products have been on an impressive streak since then, equaling the 10 consecutive day record from March of inflows. May 15th and 21st saw inflows of more than 300 million, while May 24th numbers exceeded 250 million. BlackRock's IBIT leads the pack once again in terms of inflows and has attracted over 16,350 billion. Grayscale is still the leader with 20 billion. I think it's 16.3 billion. Grayscale is still the leader with 20 billion, according to So Value, but the outflows there suggest that BlackRock will surpass it in the near future. Overall, the total inflows in all ETFs are close to $13.7 billion. Meanwhile, Ethereum fans also saw some positive developments this week as the US SEC greenlighted 8 spot ETH ETFs. However, it is still uncertain when they will launch. Bitcoin responded with lots of volatility to the Ethereum news, skyrocketing from 67 to 72 before dumping to under 66,000 this week. The past 24 hours have been more positive, perhaps driven by the impressive inflows, and Bitcoin now stands close to 69,000. And we don't really have any FUD of the week this week. I didn't see anything that was particularly offensive, so kind of skip over that. So we'll take a look at it next week. But finally, a nice piece from Bitcoin Magazine on an interview done with Michael Saylor by Chris Irons, who is the author of the Quoth the Raven Substack and podcast. And so this was posted on May 24th, and so we'll go through that. I was extraordinarily appreciative when executive chairman and co-founder of MicroStrategy, Michael Saylor, sat down with me this weekend for an exclusive interview. What's inside this exclusive Fringe Finance interview with Michael Saylor? What the effects of inflation will eventually be, the matrix, and how globalist organizations like the World Economic Forum fit into the mix. The differences between bitching and moaning about flawed monetary policy versus offering up an actual solution. Whether he thinks the Fed will raise or lower rates next and why. Similarities and differences between Bitcoin and fine art when talking about intrinsic value. If Bitcoin, now embraced by Wall Street, needs to homogenize itself into the AML KYC world of regulated banking, and if so, how that'll happen. Whether ETFs and the centralized storage of large amounts of Bitcoin could eventually become a negative and make it easier for a nation state or bad actor to seize. What he thinks of the meme stock rally into names like GameStop, and whether or not such uprisings could eventually be a catalyst for Bitcoin, as I predicted. Why he is selling so much MicroStrategy stock. What he sees as the one biggest risk to the Bitcoin network going forward. What he thinks the next nation state to buy Bitcoin will be. Whether he thinks gold and Bitcoin can coexist. Whether or not he'll finally debate Peter Schiff once and for all. I started off by asking Michael what he thought about macro and what the solution would be for the Fed that is stuck between a rock, inflation, and a hard place, depression. Saylor told me, I think they'll do everything they can to create the appearance of low consumer inflation. At some point, we'll modify the market baskets in the CPI, their PPI, and that's probably occurring at whatever rate it can. And I think everybody would like to just focus on the public, on market baskets of products that aren't appreciating too much in price, and get them to not focus on the things that are going up in price more. But the bottom line is that it doesn't feel like it'd be responsible for them to lower interest rates, or for some people who would like them to raise interest rates, he said. They know they can't afford to raise them. They would love to lower them. The numbers aren't quite cooperating with them. But if we drop coffee out of the consumer price index and then we go find 10 other things that are expensive and drop them from the consumer price index, yeah, this all comes down to normalization of life, right? If I imagine that you can live in a 400 square foot apartment built with drywall with a single flat panel screen and boxed manufactured food, I can get the cost of living down. And if I can just replace streaming Taylor Swift videos on Netflix with going to see a Taylor Swift concert for $500, then the inflation would go away. When I pressed him further about quality of life deteriorating as a consequence of inflation and how long the government can keep the charade going, Michael told me, I think they can go forever, my friend. I think they can continue to make hedonic adjustments. Why do you need a car? You could Uber. Why do you need to be able to drive when there's a self-driving Uber? What happens when we've got 1/10 as many cars and robots drive them? And why do you need to go anywhere in a robot car when you can just watch it on YouTube? And why do you need to even watch it on YouTube? You know, if you can put on virtual reality glasses, why do we even need an 80-inch television? So I could take this ad infinitum to the extreme. I mean, the extreme is like the Matrix, right? We just plug in, jack something to the back of your vertebrae and give you a feeding tube. Why do you really need a steak when you can eat hamburger? Why do you need hamburger when you can eat a soy burger? Why do you need a soy burger when you can just force feed you some sugar protein concoction or something? So when will that end? I mean, I'm being tongue in cheek, but let's just say we won't hit a crisis in the next decade. I mean, that's all that really matters, right? The rank and file, this is a quote, the rank and file average person will be forced to lower their standards and they'll have to give up their car and their house. He continued, I mean, if you look through history, there are lots of examples where people's expectations and quality of life were compressed down to the bare minimum, then expanded, then contracted again. And, I'm not here to solve that, right? Like now, when we go to macro, we're talking about solving the economic problems of the world. Very difficult. And then you get into political issues, and that's double difficult. And the truth of the matter is that it's a bit above my pay grade. My view is just yes, there will be inflation. The government will have to keep printing money, and that will cause the price of scarce, desirable assets to appreciate. The rank and file average person will be forced to lower their standards, and they'll have to give up their car and their house. Naturally, this prompted me to ask him where the World Economic Forum and all these globalist organizations fit in the picture, asking about whether the WEF and the likes are truly nefarious or simply doing the wrong thing and ushering in this new age. Saylor told me, you read Nicholas Taleb's work like Anti-Fragile and Fooled by Randomness. I mean, all of his canon. And you know what he says, in essence, is that well-intentioned people doing things are the problem, right? Because, yeah, it's doing of stuff. It's like if I put someone in charge of the world and I tell them to do good, the odds that they're going to do bad, right? He added, it's like if I said, okay, you're in charge of determining the curriculum or the education for 18 million children. Well, good luck with that. But I mean, are you qualified to do it? Is anybody? I mean, it's kind of like, right? The conundrum is central planning. Saylor then laid out the two things he sees driving Bitcoin to success. One is, if inflation of the currency is high in whatever the country is, then using a fiat currency as a capital asset becomes more and more inefficient. So obviously in hyperinflation scenarios like Nigeria, Lebanon, Argentina, or Venezuela, there's a stampede away from the currency to some other form of capital, right? And so inflation will drive it. But the other thing that will drive the success of Bitcoin is not just the inefficiency of central government or central banking planners, but also the inefficiency of every corporation. After he explained further, I asked him about my article predicting that the next economic crisis would be a positive catalyst for Bitcoin. He said about this and the GameStop saga, I mean, the people piling into the meme stocks, they have the right idea, but it's the wrong execution, or I understand their motivation. It's like they're angry with the system, and so they ought to be buying Bitcoin if they were smart, right? The people that have that sentiment, that are unhappy with the status quo and are smart are buying Bitcoin, and the ones that are simply angry but haven't thought very deeply about what's going to happen are buying these meme stocks. They feel disenfranchised, he continued. They want to make money. They feel disenfranchised. They feel like the system is rigged against them. They're irritated at the establishment, right? I mean, there's a million of these motivations, and they're expressing their sentiment through their trading of meme stocks. But the problem is, if you increase the value of a company by a factor of 10 in excess of its true value and cash flow potential, then the management team of the company just prints 10 times more stock and then the stock price crashes. Well, not only do they do it, they have a fiduciary obligation to do it. Like, if my company is worth $10 a share and you drive the stock to $100, then they've got to issue equity because that's their job. And so it's really kind of silly to express that sentiment by buying an equity policy because equities aren't scarce. Satoshi isn't going to double the supply of Bitcoin if you pile into Bitcoin. The whole point, the reason it's a commodity is there's no one that can rug pull you and there's no one that can inflate the supply. Trying to wrap my head further around the idea of intrinsic value, I asked Saylor about the analogs between Bitcoin and fine art. Talking about art, he told me, I guess what I would say here is that there's a monetary premium ascribed to the Picasso because it's deemed scarce, desirable, and portable. So it passes the Bernard-Arnault test. And the Bernard-Arnault test is, I want to buy something that a person richer than me, more cultured than me, will want to buy from me in a decade. So you ask the question, would someone with a lot of money want to own this? Well, it's a scarcity collectible for cultural reasons, but it's only valuable to people in Western culture who appreciate that form of art. So it's really a specialized property asset or specialized collectible. He continued, I think Velasquez, it's a very famous note in Durant's story of the Renaissance. He writes that the great court painter in the Spanish court went to Rome to buy masterpieces with the King of Spain's checkbook, and nobody would sell him anything because the rich in Italy kept these paintings as a store of value and an inflation hedge in the 16th century. If you have to flee with your life, and they had to do it all the time, you get kicked out of your city. You have to leave your real estate behind. You maybe carry your gold, but gold is heavy. So you take a painting, roll it up, and most, even today, if you were a rich person living in a country, pick the country and the government collapses, what would you rather have? $1 billion in gold? Would you rather have 20, 50 million paintings? Would you rather have $1 billion of a company in that country? Would you rather own $1 billion of real estate or buildings? Do you want to own $1 billion of oil? What are you going to be able to get out of the country? Your best hope is to roll up the Picasso in a tube and smuggle it out of the country. On explaining where art's intrinsic value comes from, he added, so in terms of economic density, you're like, well, why does anybody else value it? Well, bragging rights, it's a trophy asset. Like, why does someone value owning a football team? Or why do they value owning a copy of the Magna Carta? At the end of the day, it's because you have 10,000 billionaires. And once you have that many billionaires, they will allocate 5% of their wealth to those kinds of collectibles because they can, right? But it's not the world's best capital asset. You're not going to capitalize Microsoft money with art. It doesn't make any sense because the art auctions are probably all rigged. It's an unregulated market. It's not liquid. They're not fungible. They're specialty. There's all sorts of uncertainty. The Holy Roman Empire sacks Rome, and they murder, rape, and pillage everything. You can see the appeal of fleeing the town with your art. I mean, you can see the appeal of that. But yeah, Bitcoin's a better idea. Bitcoin is the idea of a fungible capital asset that all of the wealthy, powerful, educated people in the world are going to want, that you can actually teleport out of the country in a few minutes. So I think ultimately these guys get caught up in intrinsic value. And of course, the best money has zero intrinsic value. It's all monetary premium. That's the best money. It's pretty obvious. Dovetailing from the best money, I asked him how Bitcoin is homogenizing itself in a world of increasing banking regulations like AML and KYC. Saylor told me, well, I think it's doing it now. I mean, you're watching it, right? For example, Block sells $10 billion worth of Bitcoin every year via Cash App. They're a publicly traded company. They abide by AML and KYC regulations. They have compliance. They have responsibilities. There are certain things they won't do in New York State because of state laws, so Coinbase is handling Bitcoin. They're in a continual dialogue with the SEC. It's sometimes confrontational, but you've got them working on it. Fidelity, Fidelity Digital Assets is custodying billions and billions of dollars of Bitcoin. I'm sure they've got an army of lawyers and finance people thinking about it. I also pressed him on why he's selling so much MicroStrategy stock, to which he replied, "It was like April of 2014. I was given a stock option as part of my compensation for 400,000 shares. It was a 10-year stock option that expires worthless after 10 years if I don't exercise it. So I think the expiration date was like April 25th or something like that, about a year ago. I said, well, eventually I'm going to have to exercise it, so how do I do it?" He explained, "If you go back and check out our conference call sometime in the October-November timeframe, I told all the shareholders I'd put in place a 10b-51 plan. That plan was to sell 5,000 shares a day every day for 80 trading days, the last 80 days at the end of the window. I held the option for the longest I could, 10 years, and then I had to exercise it. So I wasn't actually selling shares that I owned. My shares I'm actually holding. What I was doing was exercising the option granted a decade prior. I was selling into the market to pay the cost of the option and banking the money because that was my only choice. Otherwise, the option would expire worthless. The reason you saw continual reports is because every day you have to report those, right? Public companies have total transparency, so every single day you could see exactly 5,000 shares. You could see the price they were sold at. It was all programmatic. The alternative would be to do it without a 10b-51 program and try to do it in 3 days. But that would have been much more anxiety inducing for everybody because there are lockup periods, and then people would be thinking, well, which 3 days? Why did you pick those 3 days? I was trying to be as graceful and transparent as I could in something that I kind of needed to get done. Finally, I asked him about the biggest risk to the Bitcoin network. He responded, I think that Bitcoin, the network, has won the crypto wars. As a crypto asset, it's won. It's destined to grow from $1 trillion to 10 trillion to 100 trillion, so it's winning. Just like any empire or any winner, what's the biggest risk? The biggest risk is that the people within the network get fat, dumb, and happy, and then it's overcome by, what is the word? Gluttony. There's this tendency for people in successful countries to meddle and want to fix things that aren't broken. So really the biggest risk to Bitcoin is all of a sudden charismatic, well-intentioned developers deciding to improve it themselves, and they introduce instabilities by attempting to improve it. Finally, I asked him to debate Peter Schiff on my podcast. He replied, Peter has been debating on this topic for a decade now. I mean, heck, when I got into Bitcoin in 2020, one of the reasons I bought Bitcoin was because I saw the Eric Voorhees Peter Schiff debate from 2017. He wasn't persuasive in 2017, and he hasn't been persuasive since. I think it's a disservice to promote that in general. By the way, the elephant in the room here is I don't think you can find a single person in the world who owns $1 billion worth of gold. I challenge you to find one. Go find me a person who owns $1 billion worth of gold bullion as an investment and then bring them. If you can find me that person, Chris, I'll debate them. I will debate them. If you can find me a person who legitimately bought $1 billion of gold as an investment and they want to debate me on your podcast, I'll do it. Love it. Really, really enjoy Chris Irons. He's a fantastic guy, a great follow on Substack and on YouTube. So check it out. And last, I just wanted to highlight this week's featured post on the Bitcoin Fortress Substack. The article is entitled "The Technology Behind Bitcoin: A Robust Framework for Decentralization." It's actually part 2 of a 4-part series that I'm doing, kind of breaking down Bitcoin and sort of a very simple way. It's good for orange pilling or just to kind of refresh on the basics. And with that, I will thank you for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. I do enjoy Fountain, where you can earn some sats just for listening. You can also follow my Substack. It's located at bitcoinfortress.substack.com. And if you want to follow me on socials, the only one I have is Nostr, and my NPub is included in the show notes, along with links to all the articles that I went over this week, as usual. And so with that, I will talk to y'all next week. Bye bye.